Good morning. It's Monday, the 20th of January, and this is Govindraj, Ethiraj, headquartered in broadcasting and streaming, as always, from Mumbai, India's financial capital. Well, today is that day that will be most looked forward to, and maybe backward as well, the inauguration of Trump 2.0, and more on that shortly. Meanwhile, the take. Electric vehicle cars are about 2.5% of annual sales in India. Tata Motors in electric cars controls about 62% of the market, with a declining share, having held at 73% the previous year. In electric two-wheelers, Bajaj Auto as of December held a nearly 25% market share, followed by TVS Motors at 23%. Ola Electric, the Bangalore company, though leading on an annual basis, is losing market share rapidly. Now, this is despite dropping prices drastically while the others have held on. Ola Electric has moved to number 3 from number 1 and looks like it will fall further as buyers switch to brands they trust more or feel they can trust more. Buying a vehicle is all about trust of the brand and the proposition. In the case of electric, there is a product challenge. World over, potential and existing owners live in fear that the battery will drain while in a traffic jam, and obviously nowhere near a charging station, which you cannot push your car to in any case. In the good old days, you could collect a few friendly souls and push your petrol car to one if there was a pump close by. The importance of trust becomes paramount because consumers have to take a bet on electric vehicles in general and the brand in particular. Now, this comes in the context of a heavy push by the government itself in electric vehicles, with the Prime Minister Narendra Modi making a strong case for green mobility and alternate fuels, including electric, at the Bharat Mobility Expo 2025, an industry trade show that opened on Friday last week in New Delhi. So the government is, of course, inviting investment into the mobility space because, among other things, the automobile industry contributes about 7% to overall gross domestic product or GDP, and almost 46% or nearly half of India's manufacturing sector, and thus a crucial high-skill job creator. India has never been an easy market to predict because Indian consumers place a high premium on value rather than just cost. Price it too high and your vehicle might not move out of the dealership, and discount too much and you might face the same problem. So it's not a price issue only. The good news, if so, is, as we said earlier, Indians are facing the same range anxiety issues as automobile owners world over, except maybe in Scandinavia when it comes to purchasing an electric vehicle. Interestingly, electric two-wheelers, many of them used for hyper-local delivery and the like, have already found a growing market, as have electric three-wheelers, again used for both transport and people. Interestingly, in these categories, brand in itself is not playing as much of a role in the choice of vehicle. But for individual owners looking for long-term buys, brand will matter. But product trust, unlike in regular diesel or petrol vehicles and petrol two-wheelers, has to be built not just by brands individually but jointly together and along with, let's say, the local government. Interestingly, two-wheeler market leader Honda, which has a 43% of petrol two-wheelers, recently launched its electric two-wheelers, which are priced on the higher end of the spectrum between 1.1 lakh rupees and 1.5 lakh rupees. Honda appears to be saying that it intends to approach this business as a business without discounting or depending on subsidies from the government, which are shrinking in any case for a whole variety of reasons. Honda is also indicating its confidence in its pricing and brand, and of course trust that it already enjoys as an automotive brand. As the electric vehicle industry matures quite rapidly in 2025 for many of the reasons already spoken about, and value-conscious users hopefully get over their early fears, India could do a leap, if not a leapfrog, into green mobility much faster, at least proportionately, than many other countries. Now, manufacturers are working hard on the back and front end on the battery front, including battery swapping. For example, Maruti Suzuki has announced fast charging points in India's top 100 cities. That's almost every 5 to 10 kilometers, and the battery rental service, while Tata Motors and Hyundai say they will set up 500 to 600 public chargers. So there's this, and there's building trust, which is, of course, a more subjective task, and that is something that they have to jointly do. Remember, petrol pumps are set up by oil refiners in India, almost, and hopefully 2025 we'll see a lot of that. And that brings us to the top stories and themes of the day. The stock markets are still under pressure on standby for budget cues. India is now experiencing a structural slowdown, says UBS. On Trump inauguration day, how could potential import tariffs hurt India's apparel industry? Reliance Retail has reported strong third quarter results. Does that mean consumer products are doing well? Will the US step up or down sanctions on Russian oil and what that could mean for India? India's foreign exchange reserves are at a 10-month low, down $79 billion from peak.
This is a core report with Govindraj Ethiraj.
The markets on standby again. Friday last week saw the market slide again after a 3-day winning streak. The 30-share Sensex fell about 403 points to close at 76,639. while the NSE Nifty 50 was down 108 points at 23,203. The mid-cap and small-cap, that's the Nifty mid-cap 100 and the small-cap 100, on the other hand, were up with small gains of about 0.25% and 0.2%. Earnings season is still on full swing, though nothing within them, including good earnings from heavyweights like Reliance or Infosys, is really changing the mood, even if the stocks are reacting positively for a short while. Last week, the BSE benchmark was down almost 759 points, and the Nifty was down about 228 points. This week, we'll see results from the consumer product giant Hindustan Unilever, which should give us some sense of urban demand, or at least how it's continuing. Foreign investors have now pulled out close to $5.2 billion in the month of January, or this month till now, following close to $2 billion of inflow in December. So there are pulls and pushes. The dollar is strong, bond yields in the United States are rising, and in India, the earnings season, as we've talked about, is looking weak already. And the rupee continues to depreciate, and more on that shortly. And of course, valuations, which are still seen as somewhat high by many institutional investors. In the whole of 2024, FIIs barely invested a net sum of $50 million, that's dollars. India's foreign exchange reserves continue to fall. India has evidently now decided to let the rupee float against the US dollar, at least somewhat, a strategic shift that we discussed in some detail last week. In retrospect, it does appear strange why the mandarins in the Ministry of Finance or the government in general were going so all out to protect the currency from depreciation to a more realistic level, which obviously has caused some harm. Be that as it may, it's all coming back to bite the economy now. Meanwhile, India's foreign exchange reserves fell for a sixth straight week and stood at a 10-month low of about $626 billion as of January 10th, according to data from the Reserve Bank reported by Reuters. The reserves declined by about $9 billion last week, the most in 2 months. They've fallen by about $23 billion in the last 5 weeks and are down about $79 billion from their all-time high of about $705 billion hit in late September. Reuters reports that the changes in foreign currency assets are caused by the Reserve Bank's intervention in the forex market, as well as appreciation or depreciation of foreign assets held in the reserves. The Reserve Bank, as we know, has been intervening on both sides of the forex market to curb undue volatility in the rupee, also making the rupee, to its credit, one of the most stable currencies in the world in the last couple of years. But now the Reserve Bank is likely to be more judicious, perhaps intervening only if there are very, very strong swings, and will help mitigate domestic currency market volatility, according to Reuters. The rupee settled at 86 rupees 61 paise to the dollar on Friday and also saw a steepest weekly decline in about 18 months. UBS says structural slowdown. UBS Group AG is recommending investors should short India's rupee and go underweight on the country's stocks amidst slowing economic growth, according to Bloomberg. Now, this is quite a scathing report by any stretch. The bank's research group said India's $4 trillion economy has entered a structural slowdown that cannot be explained by cyclical factors like oil price hikes or declining government spending. A structural slowdown in India, to my mind, is a call that no other institutional investor appears to have taken, at least publicly, and of course no resident economist has said that either. Now, UBS says this deceleration is underpinned by a long-term moderation in credit growth, foreign direct investment, export competitiveness, and earnings potential. The conventional wisdom that India is far removed from Trump risk compared to other emerging markets is debatable, its head of emerging market strategy said. UBS also said that a potentially higher for longer US yield environment poses challenges to India's growth, with one of the highest debt service to revenue ratios in the major emerging market space. Apart from the losses in equities, UBS says India's bonds are also recording the fastest outflows since 2020 as euphoria over their inclusion in global bond indices wanes. Market losses also follow a slowing in real GDP growth over successive quarters, showing the Indian economy slipping below the 7% average generated before the COVID-19 pandemic, and disappointing business updates following a decade in which companies in the Sensex index failed to meet analyst expectations have underscored the bearish turn, it says. And also, UBS says that the moderation in India's earning growth, which we can see, is spreading to defensive parts of the economy, such as consumer staples, showing that temporary factors such as government capital expenditure are not the only reasons behind the slowdown. Elsewhere, it refers to credit moderation, China deflation, which will lead to tougher competition, and slowing foreign direct investment, which is a big concern as India only saw about $3 billion in the last 12 months. Equities are now 23% of financial assets of Indian households and 60% of bank deposits. That means the market can no longer be termed underpenetrated, UBS said, adding that as per their valuation methodology, the country's stocks trade at a 72% premium to the rest of emerging markets, a premium unheard of even 12 months ago. And finally, UBS says that investors should buy bearish rupee options, pricing in a further 2.6% depreciation this year. All eyes on Russian oil. Oil prices were lowered on Friday, though up for the fourth straight weekly gain as the latest United States sanctions on Russian energy trade have added to worries about oil supply disruptions. Brent crude futures were down 50 cents to about $80.79, so close to $81 per barrel, but had gained about 1.5% in the last week. Sanctions on Russia are causing tightness of supply in Europe, India, and China, an analyst with Price Futures Group told Reuters. Meanwhile, advisors to incoming President Donald Trump are crafting a wide-ranging sanction strategy to facilitate a Russia-Ukraine diplomatic accord in coming months, while at the same time squeezing Iran and Venezuela, according to Bloomberg. This comes on the heels of a bombshell range of sanctions on Russia's oil trade, on producers as well as oil tankers by the Biden administration a few weeks ago. The two approaches apparently under consideration include offering some stops for sanctioned oil producers or ramping up pressure further. The latter is obviously not good for oil prices, including India, but the India advantage is that it can potentially buy lower priced Russian crude like it did 2 years ago. Scott Bessent, Donald Trump's nominee for Treasury Secretary, said on Thursday he supports dialing up the sanctions on Russian oil to end the war in Ukraine. Brent futures have gained about $5 a barrel since the Biden measures were announced, and some analysts are anticipating, according to Reuters, further gains, something that would drive up fuel costs around the world. This segment was supported by India Energy Week 2025, scheduled from February 11th to 14th, 2025 in New Delhi, and you can register for the same using the link in the show notes. TikTok goes dark. TikTok suspended its services for US-based users while Apple and Google removed the platform from their mobile app stores to avoid penalties under a new US law. The social media company is now standing by for a possible reprieve from President-elect Donald Trump to continue operations. Such a reprieve would obviously mean that the security considerations around the app's Chinese ownership that were in play in the run-up to the ban will not matter anymore, which is quite surprising to say the least, unless of course ownership changes hands. India has banned more than 200 Chinese apps, including TikTok, also on security concerns. A law banning TikTok has been enacted in the US, TikTok said in a notification on the platform to users late Saturday, which means you cannot use the app now. Apple and Google removed TikTok from their mobile app stores in the US as required by that law that took effect yesterday. Trump said on Saturday he would most likely give TikTok a 90-day reprieve from the law, providing its Chinese-owned parent company ByteDance more time to find a buyer. He also told NBC in an exclusive interview that he'd probably announce it on Monday after he's sworn in, according to that report. It's also surprising that the first thing that the President of the United States, as he takes over, will most probably be a deal with a Chinese social media app company above all other trade and economic issues, which obviously reflects the power of social media apps and China. How will India's apparel exports fare? All eyes will be on the United States and its impending tariff regime or the threat of it. So let's look at apparels. According to the Coimbatore-based Indian Texpreneurs Federation, the United States imported about $73 billion of apparel between January and November 2024 and was on course to hit about $80 billion for all of 2024. Now, of this, China and Vietnam have the major share, holding about 21% and 19% of exports from there or imports into the US. Bangladesh is at 9.3%, India is at 6%. Indonesia and Cambodia both are at about 5.4% and just a little behind India, and Cambodia is growing. So the big question, of course, is what happens if the United States raises tariffs as threatened, even by 10% on Indian apparel in this case? More importantly, how is India's apparel industry positioned at this point, including whether India has benefited from the recent turmoil in Bangladesh, which, as we saw, has a higher share of exports into the US. I reached out to Prabhu, Dhamodharan, convener at the Indian Texpreneurs Federation, which represents about 450 textile companies in the textile manufacturing chain, including apparels, and also in the well-known export hotbed Tirupur in the south of India. I began by asking him where India's apparel exports stood right now and the market view, so to speak.
we can see whether we want to understand from the perspective of whether this changes whatever happening in Bangladesh, whether it is bringing a cyclical or structural opportunity into India. Before going to the subject, I can throw some numbers so that we can simplify things in a very clear manner. Monthly run rate of apparel exports from India is in the range of 1.2 to 1.3 billion dollars on an average. And Bangladesh is at 3 to 3.3 billion dollar, Vietnam at 3 billion dollar. And monthly run rate of China's apparel export is in the range of 11.5 to 12 billion dollar, almost 10 times size of our apparel exports. This is the number we are seeing for the past many months. Maybe ups and downs are there. And so naturally from the low base of 1.2 to 1.3 billion dollar, our opportunities are definitely big and growth is very much possible. And India, predominantly, we are a domestic focused textile manufacturing economy because we have a very robust market of 90 to 100 billion dollar of domestic consumption. And that is growing year on year based on the inflation, etc. Sometimes we may not grow, sometimes we may grow. But overall, if you take a 5-year period, there is a steady growth happening. And the issue is with apparel exports. Apparel and textile exports are stagnant for the past many years. And there are structural issues because let us see one by one. And so to answer your question, we are directionally positive towards Bangladesh plus one opportunity. At the same time, personally, we feel that China plus one is a real big opportunity. For example, if we grab 10% market share from Bangladesh, that may lead to $300 million additional exports to India per month. But if we do the same math with China, if we are able to grab 10% market share from China, it will translate into a number of $1.2 billion per month. So the opportunity is more with China. At the same time, it's not easy to grab market share from any countries because Bangladesh also built scale and they're also very competitive in pricing. So this current turmoil created a de-risking mindset with buyers. So directionally, they are looking for India as a more stable, reliable, and less volatile kind of a market. So they are very much keen. So for that, how to reach that, translate into a reality, we need to work more towards few things that I can explain later.
Right. So, but you're saying that at this point, and that is more specifically in the last 5 to 6 months, at least in the context of Bangladesh, or rather not even 5 to 6, less than that, last quarter, let's say, and China maybe a last couple of years, has there been migration of contracts and have buyers being looking at India to expand their production and so on?
Yes, it is happening. Interests are there. For example, China plus one opportunity is actually real. Lot of inquiries are flowing into India. And only thing is we need to work more on few things to capitalize. So far, we are not able to capitalize in a big way. For example, what we need to do, that is a very important thing. We need to build scale, competitiveness, specialization, market diversification, and FTAs. These 5 things are very, very important. Because our apparel exports, if you take in terms of volume, for example, 2019 or 17-18 period, we exported around 54 crore number of t-shirts during April to October period. If you see current year number, we are at 56 crore. So like that, we can highlight many products. Volume wise, we are not growing in exports. So the interest is there to shift from China. We need to capitalize. How to do that? We need to break down to a few strategies. Number one, we need to build scale and competitiveness. What is meant by scale and competitiveness? Buyer is giving a particular price. If we are able to match that price, including our profitability, naturally our volumes will grow and companies also will reinvest money. For that, we need more integrated companies in India. We need to move towards two things. One is we need to encourage the companies to go for ready to cut fabric ecosystem and full integration. These two things can create global champions from India, and we can build a lot of scale and competitiveness to compete in the global market, particularly in the mass volume items like $2, $3 apparel. So this is one area we need to build scale and competitiveness with the help of Mitra Park, or many state governments are offering incentives. So we need to step up our game. Even companies, policymakers, everyone need to align towards this kind of a change to build mega scale.
This is not, I'm sure this is a realization that's been there for some time, and manufacturers have been trying to increase capacity. So the question I would perhaps could pose is, what is stopping them or what is stopping us?
Actually, there are few factors. One is, your question is very valid. The southern states who are already doing very well in apparel exports have some kind of saturation or limitation of growth due to the dependency of migrant laborers. So, whatever the possible efforts we are taking towards automation and also constructing hostels, kind of a thing to keep migrants here. So we need a common plug and play infrastructure in India at various parts of the country, so that there are two things. One is plug and play infra, so that common facilities can be created by the government and investors can go and invest. And second, the staying facilities. And the electronics is already showing the model. So we need to duplicate in textile also, so that if we are able to construct such kind of a facilities, companies will go and invest. Already Vietnam created such plug and play and combined with staying hostel facilities, so they are very successful. We need to duplicate that model so that more investments can be attracted. And second point, specialization I mentioned. For example, US imports around 7 lakh crore worth of apparel. In that, 3.5 lakh crore apparel is from cotton and remaining 3.5 is from MMF. If you take our share, we are 10% plus in cotton apparel and just 2 to 2.5% in MMF apparel exports to the US. So almost 50% of the ground we are not playing the game. That means we need to improve our capabilities in MMF apparel manufacturing, because now the trend is moving towards MMF apparel, athleisure, and lot of functional improvements are there in fabrics. So we are lacking there. So it's a structural issue. It is not possible to overcome this in an immediate manner, but at the same time, we need to work towards with a 5-year plan so that something may happen, or otherwise we can't grow in growing market, particularly in the growing segments. So specialization, another area we need to work. So this, to answer your question of how we can bring kind of an interest among entrepreneurs to invest more, plug and play facility with hostel and staying facilities can be a game changer. That is the one area we need to focus hereafter.
So, but you're saying that, there are so many things which will go into manufacturing garments, but you're saying that the importance of skilled workforce, which is resident in and around factory, is perhaps the most critical, one of the most critical components.
Yes, it is one of the most critical components in terms of building scale. We have a great scale. We are the one of the best low cost or very competitive producers of world class yarn in the global arena. But at the same time, after spinning, all our majority of SMEs are working. SMEs also need to survive. We need to plan separate strategies for them. For example, SMEs can concentrate on value added apparel instead of fighting with $2, $3 apparel, which can be a space for large players. And SMEs also invest in automation. And SMEs also will enjoy this kind of benefit if we are able to give this kind of a common infrastructure of processing facility in a plug and play model. And also, it's right time to launch cotton PLI. For example, in the past, PLI scheme launched for MMF apparel. But now the opportunities are very big. It's right time to step in and announce a more suitable scheme for SMEs also in PLI, so that they can also scale up by using the opportunity.
Last question. So next week we'll see the inauguration of a new presidency in the United States, and Donald Trump will take over, who's already threatened wide-ranging tariffs, higher on countries like China, Mexico, Canada, but also uniform tariffs across many other countries, including potentially India. So how is the industry gearing for that, if so?
See, it's a simple math. Already China lost around 6% market share in the over period of 5 to 6 years. In US market, they came down from 27 to 21%. And the benefit went to various countries. Each 1%, we gained 1%, Vietnam gained 2%, Bangladesh gained 1%. So the benefit is going to various countries. Now with this Trump next version of tariffs, naturally China will have more duty. That will motivate more sourcing companies to focus on newer markets like India. At the same time, there are many things are there. For example, Shein, new age e-commerce company,
which has just come back into India with Reliance as well. Yeah.
Yes, if you take US tariff, if it is a below 800, the small parcel orders like e-commerce exports are not under duty. Shein and many brands are using, and I think 25 to $30 billion exports are happening in that manner. So they may attack that area also to stop such kind of an exports, because the Shein kind of a model, it is from design to factory, they are designed to delivery, they are keeping 15 to 20 days time. It's a robust mechanism they created. So by using this loophole of the shipping parcels with e-commerce and eliminating duties, they have gained a lot of volume. So the Trump administration may look into that. Number two, how they are going to treat connector countries. For example, Vietnam is a very big connector country for China. Whatever the of apparel ecosystem China gained experience, exposure, they translated into Vietnam. Now Vietnam is almost near the market share of China in US. So how Trump administration is going to see the connected countries and whether they will impose tariff on Vietnam, that is main area we want to see, so that some more benefit will come to India.
Thank you so much for joining me. What are Reliance Retail results telling us? India's consumer product sector growth is slowing down. While this is impacting the overall basket, how is retail doing, and could Reliance Retail's results provide any clues? So Reliance Retail's net profit in October to December rose about 10%, that's the third quarter, to about 3,485 crores over the same quarter in the previous year, while its earnings before interest, tax, depreciation and amortization, or EBITDA, from operations increased about 10% to 6,600 crores. Now the company's revenue from operations at about 79,000, close to 80,000 crores, was up 7% year on year, while gross revenue increased about 9% to about 90,000 crores. So the company has said that it saw strong sequential growth thanks to several factors, including productivity and festival sales. Reliance Retail has also done some amount of rationalizing of stores. It said that it saw a footfall of about 296 million across formats and opened about 779 stores in the quarter, taking its total to 19,102 stores. Digital and new commerce and these channels now contribute about 18% of revenue. The fashion and lifestyle business and apparel and footwear apparently saw a strong bounce back thanks to new designs and improved store experience. I reached out to Karan, consumer analyst and senior vice president at Elara Securities, and I began by asking him to decode these results for us and what the larger signals, if any, that he was seeing in the retail segment.
So retail overall as a sector, I think, is under some kind of stress. Now it's a mixed bag. There are certain categories like the fast fashion segment, which are reporting strong growth in excess of 30-35%. There are certain categories like FMCG, which are probably reporting muted growth, right? Because what has happened is that you have seen a transition towards quick commerce, and more than 70 to 80% of the sales or the order volume on the quick commerce side is from FMCG. Beauty, personal care as well is a mixed bag. It has seen very good adoption on quick commerce platforms, e-commerce platforms and online. And maybe that is why the traditional segment within that is also struggling. So one has to understand the fact that even today, as we speak, all these categories are very heavily dependent within the traditional businesses. So whether it be BPC or FMCG or apparel or any category, close to 70-80% of the revenue does come from the offline channel. Apparel, I think, has a higher online share, but broadly, if you look at the other categories, 70 to 80% comes from the traditional channel. And digital channels seeing adoption because of better customer experience, because of quick commerce, because of customers becoming impulsive in terms of purchases, and so much of competitive intensity within so many platforms. There are super apps, there are niche apps which are there. So clearly, if digital has to grow at a faster clip, it has to grow at the cost of traditional businesses, traditional segment rather. So if you look at the modern trade business, or if you look at the general mall store, kirana store, or any other general trade business, those are the businesses which are seeing muted growth. And that is where Reliance is also coming, and that's where other companies also play. So whichever offline businesses are there, they are seeing muted growth at the cost of digital adoption.
So how does one interpret a 9% year-on-year growth in this case, particularly given what sales or numbers would have been in previous years?
So I think if for Reliance, I think the base is extremely large. They are one of the conglomerates as far as retail segment is concerned. And 7% growth on a YY basis is a reasonably good, healthy number. Because last year too, if you look at the base in the festive season, it was not that compelling because There were not too many weddings. And I think this time around the festive season, we have seen more weddings as compared to what you would have seen last year. So that has led to this fillip. Second thing which has led to some kind of fillip, for the growth in this quarter has been the base as well. So if you look at it on a quarter-on-quarter basis, you are talking of 20% quarter-on-quarter growth, which is extremely strong, which did not happen last year as well, as far as growth is concerned. But, this is coming at the cost of low base again, because if you look at Reliance Retail's performance in last year festive, in the earlier quarters, they had reported growth on a Q-on-Q basis. But this year, if you look at Q1, Q2 performance, and even Q4 for that matter, the base has kind of softened and you've seen a decline anyway in the range of 4 to 5% on an average on a Q-on-Q basis. So there are two factors to articulate here in terms of the boost in growth. One is, of course, the weddings, and second, of course, is the soft base.
Right. So the company is saying they have about 19,100 physical stores right now, with some additions in the last quarter as well. So how does this compare with their earlier portfolio of stores?
If you look at their stores, I think they've been adding stores at a very healthy pace. I think where they are right now in terms of overall retail space or in terms of the overall square feet present, they are on the verge of rationalization right now. If you look at their overall retail space, it was around 73 million square feet last year, which is now at about 77, 78 million on a YY basis. There is growth here. But if you look at this on a sequential performance, or rather over the last 2 to 3 quarters, we are seeing a trend wherein you are seeing a decline in terms of the overall square feet space. Now, this could be because of two reasons. One is, of course, the new stores that are opening up, maybe smaller in terms of size. Second, very big factor is that you are seeing rationalization in certain categories. So, as I mentioned, FMCG, BPC, these are certain categories which are seeing very healthy adoption towards digital, led by e-commerce and quick commerce. And this space is going to intensify from here on, because if e-commerce companies come into quick commerce, if they are able to deliver within 10 minutes, competitive intensity will grow towards quick commerce, and you will find more adoption towards the digital channel. So very clearly, I think they are right now in a mode of consolidation. You may see another 2 or 3 quarters wherein there could be a decline in terms of this overall space and decline in terms of number of stores as well.
Right. And what would online be as a proportion in the current revenue or the total revenue mix right now?
So for Reliance, I think given the kind of size and scale that they operate in the retail segment, around 18 to 19% of their business today is digital and new commerce. And within that, they are also trying to do many different things. For example, if you look at JioMart, has been into the e-commerce side more for the FMCG segment. They are also venturing into a lower lead time. They are trying to get into quick commerce in a different manner, rather wherein you'll have the pickup of the products from the stores rather than having dark stores where how quick commerce operates today. So I think they are making inroads. They are doing this entire innovation. They also don't want to miss the bus in terms of digital adoption, in terms of digital growth. But this number has to really scale up, because this number has been stable over the last 3 to 4 quarters. So this number has to go towards 30%, beyond 30%, if we were to see that Reliance is doing well on digital as well. And I think it's going to be all about lead time, user experience, assortment, localization. These are the moat which is going to drive the quick commerce engine in India today.
I don't know whether we have the insight into what margins are, but what is the difference in, let's say, profitability between the digital side and the physical side right now?
So we would not have the breakup of the digital and the physical margins for now, but as we all know that digital businesses are making losses. So if you look at the likes of platforms like Ajio, Myntra on the fashion side, the other quick commerce businesses, the other e-commerce businesses, most large platforms are making losses. And the reason is very clear. Why are they making losses? Because I think on the apparel side, majorly, there's a lot of discounting push which is happening. You need to give customers a lot of discount for them to kind of shop online, get used to shopping online, drive more frequency of the customers, and also spend on promotions, marketing to acquire customer as well. So I think the online businesses are currently loss-making in nature, and that's what would be the one for Reliance Retail as well for now, because none of the platforms are making profits. But yes, I think there is one respite for online businesses today, which is the digital advertising revenue. I think ad revenue is going to be a very big lever for all these platforms to drive some kind of profitability. If you look at any of these e-commerce companies, anywhere close to 3 to 5% of their GMV is ad revenue. So ad revenue is a very big lever to drive overall profitability or reach a break-even part.
Right. And when you say ad revenue, this is the money they earn for advertisements they display on their platforms, as opposed to advertising elsewhere for consumers to buy.
Yes, absolutely. So if you look at all these platforms today, they have got a reasonable customer base. And as we all know, as a thumb rule, ad dollars follows traffic, customer traffic. So because they have a reasonable customer base, because they have a customer base which is high frequent nature in terms of shopping experiences, and they've got a reasonable amount of assortment as well, that is where typically the advertisers are interested and they want to kind of monetize that customer base on their platforms.
Right. And last question, how are you seeing, what is all of this telling you in terms of overall retail demand and consumption right now at a macro level?
Yeah, so overall retail demand has been mixed. If you look at the QSR companies as well, which are a part of the F&B retail segment, even over there, they have reported a decline in SHG, or they're rather going to report decline in SHG for this quarter in the festive season. The festive has not been that great. Apparel companies also, if you look at the fast fashion segment, that's the only segment which is reporting strong growth of more than 30%, but that's primarily because it's a very small share of the overall apparel industry. But if you look at the industry as a whole, there are no big positive surprises as far as growth is concerned. There are no big levers for margin improvement from here on. So things, I think, are mixed on ground. And I think over the near term, they will remain to be how they are. We don't see any sharp acceleration as far as demand is concerned, at least for now.
Right. Karan, pleasure speaking to you. Thank you so much for joining me.
Thank you so much, Govind. Pleasure as always.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.